I wanted to pose the question about tax bills in California's legislature in reference to Section 41. So, if you've taken a look at some bills in the legislature in California that add new provisions to the California Revenue and Taxation Code, you may see a reference to Section 41. So, what is it and why is it often mentioned in tax bills? Basically, California's Revenue and Taxation Code, Section 41, requires any bills that have been introduced after January 1, 2020 to contain certain information if the bill would authorize a new tax expenditure. And basically, tax expenditures for Section 41 purposes are defined as credits, deductions, exclusions, exemptions, or other tax benefits provided for by the state. Now, these new tax expenditures would fall under the personal income tax law, the corporation tax law, or the sales tax law. And Section 41 basically says the bill has to contain three things: specific goals, purposes, and objectives of the proposed tax expenditure, detailed performance indicators for the legislature to use when measuring whether the tax expenditure meets the goals, purposes, and objectives that are stated in the bill, and any data collection requirements to enable the legislature to determine whether the tax expenditure is meeting or failing to meet, or of course exceeding the specified goals, purposes, and objectives. So basically, when a bill is introduced in the legislature, you might see a statement of intent that the bill will comply with Section 41. And sometimes the detailed provisions are actually contained in the introduced version. Regardless, however, by the time the bill reaches the governor's desk, it has to comply with Section 41 and contain the required information.